Good morning, everybody, and welcome to our webinar this morning, Securing Advantage Through Employee Ownership. My name is Kevin Uphill, and I'm the Chairman of Avondale Corporate. I am today going to be joined by Gareth Davies from Ice Roofing and Cladding, who have just gone down the route of selling their business to the employees, and going to be sharing some of their experiences of what worked and what didn't, what they liked and didn't like. We've got about an hour today. I'm hoping to get some questions from you guys. So the first 25 minutes, half an hour is just me giving some context and backdrop to what's happening in employee ownership. But we would like to take some questions from you in the last half an hour, where we'll be bringing Gareth in to also, if you like, chew the fat and explore on what worked and didn't work for them as employee ownership and what they liked and didn't like. We will be recording the webinar, so if you like it and you want to share it to any of your colleagues, please do. If you don't know Avondale, we help people buy and sell companies. We've been doing it some nearly 30 years. I'm the chairman, and I've also helped do some of the strategy side of the business. And the first employee-owned business we did was actually down in Bristol in 2016, where we did a valuation. And we didn't know what it was. So we had to walk into the wilderness and do a lot of studying to understand it. Why did we get into employee ownership trust? Well, quite simply, not every company works well on a trade sale. And we know that from our own experience. So we felt that it created a really good alternative opportunity for people who are thinking about succession, thinking about a sale, but don't necessarily want to do a trade deal. Why would they be like that? Why would they not want to do a trade deal? Well, post-COVID, of course, profits have been disrupted. So that's a key problem for trade deals. Whereas employee ownership, the sellers, effectively the company buying itself for the benefit of the employees, can take more of a view on the post-COVID recovery. Obviously, the big sale point of employee ownership, capital gains tax, 10% on the first million when you sell a business, 20% thereafter. We think it will go up. All the main government parties want employee ownership trust. So we've got this great benefit right now of a 0% capital gains tax to encourage them. So I am going to be talking about creating competitive advantage for employee ownership, but I do need to talk, just to give you a little bit of foundation about what they are and how they actually work, just to give a little bit of foundation, if that's all right. So they are a seller-led sale, vendor-led sale. Typically, we don't talk to the employees until we're very happy that we've got tax clearance and a valuation and financial model that works. Most of the deals we're doing are a mixture of loan notes and distributable reserves on day one in terms of driving the valuation. We've just gone for clearance on two, and actually we got response back from the tax office, one at 20 million, one at 5 million in 10 days. So that confirms, I think, even HMRC have got the brief, be keen. We're really focused on these. Why do we think government want these? Difficult to know exactly, but I think all the stats are that employee-owned businesses are more productive. My own personal view is that it helps with the story of levelling up and social mobility. Why have just a few shareholders benefiting from the profits when ultimately on an employee-owned business you can create a model where the wealth is more distributed than the shareholder-driven model. Employees can benefit up to 3,600 tax-free employee bonus, so it's great for them. That helps create succession, it helps create retention, and it motivates. Doesn't necessarily make a difference to the senior management, because probably 3,600 tax-free doesn't make a huge change in their lifestyle. But for, if you like, the guys and girls on the shop floor, this is a real difference. It makes a difference between when they have a holiday or they don't have a holiday. Now, of course, one of the really key things when you do employee ownership planning and or sales is to make sure that we do load a bonus in from day one to send the signal there's a big change. I'll talk about that more later. Why do other sellers like it as well? Well, it creates succession. So if you go, well, actually, we don't think trade works, we're not quite ready for trade, we're not quite ready to hang our boots up, we want to stay involved. They're very flexible, and many of our ex-sellers stay as employees. We'll hear from Gareth how that's going for him. Now he's no longer the shareholder director boss and is effectively just an employee, and what that's felt like later. We call it creating good companies. So what we're saying is not every business is right for a trade sale. Some are better to go an employee-owned route. They are better also than perhaps management buyouts, because typically you can do loan notes because sellers stay involved instead of a typical management buyout, which is normally financed over sort of 3 and 4 years with really hard bank debt. You finance them over a longer period, so they're much softer in terms of leverage. And again, that's very positive. There are now some 600 employee-owned companies in the UK. Arbuckle's Restaurants is one we did. Richard Sounds, the hi-fi people, you'll know. It's not actually Sean the Sheep. It's just that I have sheep, so I had to use that logo. It's actually Ardman Communications. They own Wallace and Gromit. They've gone this route. Ice Roofing and Cladding. So the estimate today is that 1 in 20 mergers and acquisitions are now the employee ownership route. So we really can't ignore this when it comes to succession. But as I say, there is a perception that these business models aren't commercial, and I want to bust that myth today. That's our main focus. So just to remind you on structure, and for those of you for those of you who don't know, for you or your clients, what we do is we set up a new co. Increasingly, they are what we call limited by guarantee. So there's no shareholding directly, and they own the shares on behalf of the employees. So again, no direct ownership in the employees. Some have what we call a hybrid model. So there is some direct ownership, but you must sell 51%. Now, we challenge a little bit the holding on to shares, because the capital gains tax at 0% only occurs as a one-off event, so just at the first point of sale. So if you do retain shares, we're going to be facing capital gains tax on that sale whenever that may occur. The other issue that retaining shares brings up is it brings up a whole host of debates about, do we pay loan notes versus dividends? So we're relatively keen on 100% sale wherever possible. So new co is set up. That buys old co. It buys the shares for the benefit of the employees and holds the shares for the benefit of employees, and typically no direct ownership. When you've done it, you end up with 3 panels. You end up effectively with an employee panel, which is an employee voice. Now, some people go really into this. They go for an employee committee, and that might work with very large companies. But I think with most of what we call the emerging mid-market, where we specialize, which is, you know, the sort of 300, 400K plus profit up to 7, 8 million, those companies won't start with an employee committee, and there's a reason for that. You have your management board. They operationally run the business, and then you have the trust board, which are the directors of the trust company, typically a minimum of 3, 1 professional director, trustee, normally an ex-seller to keep an eye on any loan notes, and then an employee representative. Now, we put management centre stage because they're the ones that drive the business growth and look after the operational business model. We're very keen that whilst we want to hear more from the employees to get across the point that these businesses are not committee-run businesses. They're not, you know, cooperatives in the sense of absolutely democratic management. When business models are increasingly under stress, in our strategy practice, we did some work on this the other day. The average business model is changing by over 50% in a 10-year period. You need agility. So you cannot run a business democratically. You do have to keep some autocratic involvement. So management sits centre stage in understanding how you drive the commercials. I'll talk a bit more about that again in a minute. How do you finance them? Well, I mentioned this. There's a bit of cash reserves. Many of our clients stop taking money out pre-sale to build it up. Vendor loans, typically between 6 and 8 years, put some interest rate on to create incentive for the trust to pay them. Now, these are softer than management buyouts. So a peculiarity of the 2014 legislation on EOTs is that the vendor loan is a promise to pay subject to cash flow. So one of the big areas that we have to work on is what are the seller's protections for those vendor loans? They're called reserve matters. We spend a lot of time legally worrying about that. We cannot control the business. The trust must have control. So yes, you must sell more than 51%, but we're also very keen to send a signal that the management and board do also change at the point of sale. Some of these are being done where people are getting the tax relief, effectively flipping income for capital. Not necessarily anything wrong with that, but what they're then not doing is looking at their succession and handing over to the employees in terms of decision making. And I think that's important. It needs to be led by the management and then ultimately with more team involvement. Let's look at that, because this is the really key point to today's webinar. Are employee-owned businesses commercial? Why is there this perception that they're not commercial? And how do you actually create a better business model for employee ownership? Can it be done? Now, I had a debate with, we do a lot of private equity work in our M&A practice. I had a debate with a private equity contact the other day who said, no, without the shareholders skin in the game, owning direct shares, we don't believe that the management will drive the growth and the business will ultimately fade because you haven't got the incentive to drive and grow the business at that management level. And I think I said to him, the debate back is actually, you've got a generation of people coming back who aren't necessarily as excited about being ultra rich with the in and out driveway and the holiday home. They're much more interested in how their business model is ethical and how they can enjoy life rather than ownership. They aren't necessarily going to want to do management buyouts, and this model can pick up very well for those people, but they do need to have an incentive. So the real incentive, when we do the valuations on these, when we look at the management, what we're looking at doing is trying to figure out how we can start to push that central team, if you like, the next generation, into the upper quartile of pay for the sectors. So the management will run the operational business model, and it is up to them long term on a tag team basis, so sellers can stay involved, to work out what the business model is going to be as time evolves. So actually, you really can't do employee ownership without looking at how you are going to train and build succession within that second tier to get them to drive the growth of the business. So I've used the metaphor here, employee ownership, a better house. And there is, of course, this question mark, can it be commercial? Well, remember, we want to hear from the employees. We want to understand where they are and listen to them more. We do not want them to run the business by committee. We're not going to make the decision on the Christmas party by committee. That is run by the management. We want to hear from them, but ultimately we need to be making the decisions. And ultimately, therefore, we need to build a team to drive the growth of the business, and they probably get their wealth and motivation through looking at their pay package over time. Now, the trust should not be getting involved in the operational business model, but it does have one fundamental right, and that is to appoint the directors and therefore consequently also look at the directors' remuneration panel. So again, come back to those employee managers and ultimately employee managing directors. The best way to think of an employee-owned business on a commercial basis is to think of it as an employee-owned PLC. PLCs can be highly commercial. Many of the managing directors don't own many shares. They are paid highly commercially against the success of the business. So that is how you drive a commercial business model. And it's really important also In terms of sending a signal of change to the employees, yes, we want to hear from you more. Yes, we want you involved more. No, we don't want to run the business by committee more. So from day one, we are going to load in an employee bonus into the model. Now, that will impact on valuation because, of course, that's coming out of profit. But because you've perhaps got that longer period than, say, typically a management buyout, 6 to 8 years, ultimately, it still means that we can usually get full commercial valuation for the business as if it were on an open market basis, with that benefit of the 0% tax. But the best signal by far to employees of what's changed here is, guys, we've sold the business to a trust to be run for your benefit. You will be getting an additional tax-free bonus every year. We have loaded that into the business model. Heads down, crack on with the job, please. Hopefully we'll earn that bonus. Now, of course, it's at the discretion of the trust, but we were having a debate with someone the other day. We've done quite a few of these. One of them, their business model has been interrupted by COVID. The loan notes are going to be extended in period, but we discussed with them that they need to pay the employee bonus ahead of the loan notes, because they need to send that signal that a change has occurred and it is an employee-owned business. So I liken it to a house. Employee ownership, foundations are employee motivation. Employees, co-owners, and if you remember even John Lewis and their partners, they are slightly better paid than their contemporaries on the shop floor, and they care more because they have the pride of being co-owners. And ultimately, that's a stronger initiative to achieve successful outcomes in the change of the business. So you can really use this to drive both productivity, retention, sustainability, and inclusion, so long as you think about how you are creating a stronger board alongside the process and creating a more team-driven business as you go. But that's not a committee-driven business. So the key sits within management in terms of the competitive advantage, and ultimately some of the normal rules therefore apply to EO. What's the business model? What are the competitors doing? How's the business model changing? How do we stay ahead of that? So EO businesses need, like any commercial enterprise, to be fully adaptive organizations. And for me, that's about the CEO, FD, management team, board being humble, listening, spending time researching, the classic working on the business, not in it, not doing the day job too often, but actually also having the time to think about the strategy. So when you do EO, the usual questions apply. How often do you have management meetings versus board meetings? What's the difference? And also, what's the difference between a board meeting and a strategy meeting? Well, for me, strategy meetings are, what are our customers going to want tomorrow? What's their future demographic? Board meeting, typically more governance. Management meeting, is John or Janet any good at their job? And by the way, you've probably been asking that for 6 years, and you know that if you're still asking it after 6 years, you probably know the answer. Maybe we need to take some action. So it's really important that those fundamentals still apply. And it's also very important when you do this for the shareholders to understand how they're going to step back and create those new habits in building that new board. So again, the board sits centre stage, and we're looking for people who are humble, great listeners, open-minded, willing to go on training. If you're promoting from beneath, you need to be looking at making them understand their fiduciary duties. Slightly more complex fiduciary duties as employee-owned, because you're not just accountable to the shareholders, you're also accountable to the employees. And then it's also designing business models so they have the time to think about their strategy as they go ahead. And I think, if you've got the incentive for that senior management around upper quartile of pay, ultimately, I throw the debate out here in terms of the difference between what we call general managers and a managing director. So general manager will run the business day to day. The managing director will alter the business model against and according to the future trends. So I have something I wrote a book called Creating Competitive Advantage in Dynamic Markets. And one of the key premises in that is it is possible, if you have the time to research and you look at both parallel sectors and spend more time looking at the trends in your own sectors to anticipate changes in the marketplace, and therefore adjust ahead of those changes rather than behind. And if you do that, what you do is you create a business model in pull rather than push. You're not having to persuade your customers to come to you. They are coming to you because you have a we want, we need motivation, because you've anticipated what they are likely to want in the future. Now, I'm not talking about predicting the future entirely. Of course, none of us can do that and we'd all be super rich. But I am talking about understanding the trends, looking at the demographics, and being more open and asking the questions, where are they going to adjust? So again, if I look at, so for example, Avondale business model, increasingly in our M&A team, more than half of it is private equity now, rather than just trade sales. And that's a fundamentally different deal structure. We anticipated that and had to put a lot of effort into building our private equity bank. But EO is also a good example. Not every business is suitable for a trade sale. How does EO work? How can we help people create better business models through using the employee ownership deal? It's not just about tax, and it's not just about getting your value out. Can we do this in a way where we create more productive and sustainable businesses? Now, a really important point on that is 7 to 8 years later, after loan notes have been paid off, sellers go, okay, we've realized value. What should happen is the profits of that business will start to be distributed slightly more amongst the employees. So the employee bonus, typically up to 3,600 a year, you can build on. You don't start at that level. You start at 800 or 1,000, and you build it over time. But when the sellers have been paid off, that's when it starts to get really interesting. And I'm not saying all the profits would get distributed to the employees, because then you're creating a problem where employees really are commercially out of line with competitors. But certainly, again, back to upper quartile of pay with bonuses. But if you then create that position, there should be spare cash for these businesses to reinvest more. So I think what you can do, if you set this up correctly and you explain this correctly to management, what you can do is leave a legacy where the business is being pushed more in perpetuity for the benefit of the employees. They're less likely to be sold. They are more likely to reinvest, because there's more profit and there's no shareholders taking them out for, if you like, lifestyle reasons, so they will reinvest more. Therefore, ultimately, these business models can form part of what I call purposeful capitalism, i.e. a slightly more ethical business model that contributes more on a sustainable basis. Now, it's really important that within that, the same business models apply. What are your future customers going to be looking for? How can you be better than your competitors? And we need to train the second tier to ask those questions, and when they step up to the top tier in the employee-owned business model. So I'm going to bring Gareth in a second, but I just want to talk about some of the cons, if you like, so, of this. Pros: we can be much more relaxed on the post-COVID recovery model. Due diligence friendly. The company's buying itself for the benefit of the employees. So if there are issues on due diligence, we can be more open and relaxed, and therefore we can hit fair market value. But as I say, some people are doing this and still not resolving that issue of how they create tag team within the senior team and the board. And there are some who go, doesn't matter how well paid the senior management are, without shares, they're not going to be incentivized. I don't believe that, but it is one of the criticisms of the model, so we need to be open about that. So this is where, when we do these, we believe the only way to do it is a full service. So Avondale, if we're off acting, if you are interested, we are doing both legal, financial modeling, valuation, full tax clearance, First year is professional trustee. Really important that you have a professional trustee that's on employee-owned business model, understands it, so that they can make sure they don't interfere with the management and the operational side. But actually, really center stage is the strategy. How are we going to build that second tier? How are we going to train them? How are we going to get them to look at the business model and communicate it in a way that is effective across the whole team and group? And that ultimately is the center of these. Otherwise, they're just a nice tax-free sale, but you don't achieve succession fully in the business. Our typical timeline for these is 3 to 4 months. We've got some where we're taking much longer because we're not happy that we've quite got that second tier team, if you like, to hand over, and we want to build them and put them in place. But look, that's enough for me. Gareth, could I ask that you join us? And could I, guys, ask if you've all got any questions, please fire them into the Q&A. We haven't had any so far, but we'd love to take some questions from you, because there's nothing like learning from someone that's actually done it. Gareth, are you there?
Hi, Kevin. How you doing?
Yeah, could I ask you to turn your video on? Is that all right?
Yeah, of course, yeah.
I'm going to do it. There you go. Look at that. I'm going to stop the slideshow if that's all right as well.
Cool.
Just for now. The slides will be available, by the way, for those who want it.
What is the cost of the process, Kevin? There you go, straight away. That's your.
Well, there we go. That's a killer question.
It is, yeah.
I should throw back to you then, Gareth. With our cost of process, is it value?
I think absolutely, yeah. I mean, it's all calculated within the model, and yeah, for the benefit from the vendor's perspective, and also from the employees, I think it's reasonable. We didn't shop around. We just, we really liked what Kevin had to say. Really impressed by everything he put forward. So yeah, no, it's absolutely value. Yeah, 100%.
There's a big plus, isn't it, that corporation tax deductible and VAT deductible to the company.
Absolutely.
If you sell direct to trade, it's a cost to shareholders, so that's a big plus. I have to say, we don't try and be the cheapest, because the strategy side of it, I've got a call this afternoon on one with 200 employees, and we're really having to work how we're going to change management forward. It's a very unusual industry. So the strategy and the comms and all the toolkit that we have around that tries to create a no-nonsense position, because otherwise, what happens is people get distracted from running the business. What's your view on that, Gareth?
I agree. Yeah. From our point of view, I think it just kind of leads on to, am I jumping the gun to the question?
No. I want you to ask the questions. I mean,
a couple of the points that Kevin's already made, the trade sale for us, construction, rightly or wrongly, can be quite volatile. So trade sales, in particular in our sector, in the roofing sector, they were very popular about 10 or 15 years ago, but I think there were some quite bad stories, companies going bust and whatever. So that was when this really sort of hit home. MBO was going to be the other option for us, but as Kevin mentioned a few times earlier, it's a lot harder sale in terms of, I've actually been involved personally as well with not from a buyer's point of view, but just working for a company when an MBO was going through in my earlier years in construction, and it ended very, 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 very sourly for the seller, who wasn't wanted to cut a long story short once the deal was done. So I think this softer sale where, I'm still going to be around for 5 or 6 years. I think that's just to answer there's no name there, is there, Kevin? It's anonymous, but yeah, the trade sale against the OT, that was it for us. This was by far a much more attractive option, not just in terms of from a vendor's point of view and all the tax benefits and everything else, but yeah, in terms of sustainability, we bought into it 100%.
Yeah. I'm going to read another anonymous here on fees. 2 to 3% is typical. I think 10 to 15k in terms of feasibility study and clearance and so on, depending on size of the company. I'll take that one off the table because they wouldn't leave us alone on the Q&A on the cost there.
Yeah.
Good question here. What was the biggest mistake you made in implementing EO, Gareth? So
what did you
get wrong? So we know we got some stuff right. What, in your opinion, did we get wrong? I mean, I think you mentioned that the employees just didn't grasp it to start with.
I think that's probably the most, just the general process or mechanism. Trying to get your head around that for and I'd like to think myself relatively intelligent, but even from mine, and explaining it to friends and family. Well, who's bought it? Someone's got to have bought it. Well, no, actually, it's now an employee-owned business, but it's set in trust. So I think that was perhaps the biggest mistake, and trying to get that across to the employees, who, with the greatest of respect, we're talking about, guys that, are trades guys, very good at their jobs, but trying to explain this kind of element, buyouts, MBOs, it's like double Dutch. So I think that was perhaps the biggest mistake. Maybe we could have put that across in more layman's terms, but we got there in the end. I mean, there was quite a bit of nervousness amongst the staff. What happens after the 6 years? Is that it? Does it all fall? Well, no, again, and that goes back to this kind of softer exit, where this time period gives us, some great breathing space to make sure that there is sustainability and longevity in the company, and to make sure that, okay, perhaps some things aren't 100% right now in the management team, but we've got plenty of time to get that right. Testament to how well we're doing already. We're looking at repaying an early loan note repayment in the first year. The bonuses are looking very, very strong for the employees as well. So yeah, we might have broken the mold there, but
I love the story.
Yeah, I think that's
I love the story you told me about our professional trustee actually going up on the roof to explain.
Yeah,
yeah. So that's going the extra mile, I have to say.
Yeah, it is. Yeah, and I think, and that was really good, Kevin. And again, with the guy that we've got involved as the independent at the moment, he's very approachable, very knowledgeable about business in general, but just a nice guy as well. But yeah, the fact that he rang me up and said, would you mind if I went to site? I said, well, I'll have to check it with the management board. It's not my decision anymore, is it? But absolutely, he went on site, and I think he put that meeting with some of the operatives, really put their minds at rest as well about some of the things that we had tried and portray when we informed them what was going on. But no, that was great.
So, and I think sort of come back to your point about the mistake on employees. I just want to comment one more on that, which is they don't have to get it. I'm not sure employees all fully get the shareholder model necessarily. They have this viewpoint that, shareholders are all greedy capitalists taking the business, and they forget that they took all the risks in starting it. They have all the risks in running it, and they have those bad years where they have to back it and bank it. I think, you could have a shareholder buy a business who lives in the Middle East and has nothing to do with the business, or you could have a trust shareholder. What's the problem?
Yeah, absolutely.
So I think it's ultimately for the employees, it's about how you send them the signal long term, that they're going to get more bonus and earn more money, and therefore it's worth being more productive. And also, once loan notes are paid off, you could probably start doing some interesting things, better healthcare packages, gyms, that kind of stuff, which, shareholders, they like the sound of, and then they think, maybe I'll get the new car.
Yeah, absolutely.
So I think that's important. Okay, so a couple of questions possibly for me here. What size companies does this tend to work for? Well, the minimum really, you've got something called the participator rule. You can't have 2 sellers to less than 5 employees. So really it sort of works at 7+ employees, and ideally 10+ would be the size. Gareth, you've got what, 30 people, I think, off the top of my head? Is that right?
Yeah, 30 directly employed staff. We do use subcontractors as well, but generally on the books is 30. Yeah,
it's a good size. Okay, I think this is a good one for you. Could you please give examples of decisions that employees get involved in now, Gareth?
Where's that one? Let's have a look.
That's from Loud Casakina, 958. That came in.
958.
That was an early question. And so I've got one other. What advice do you give if not all the shareholders wish to sell to the trust? Okay, hence 1 or 2 shareholders want to retain. So I'll probably cover that. But yeah, so Examples of decisions you're hoping the employees get more involved in.
Yeah, I can't even see that question.
Yeah.
I mean, yeah, it's still relatively early days. Obviously, we do have a member of the staff within the trust currently, and to be honest with you, Kevin, from the very offset, has said, once this thing goes through, it's business as usual. And from our point of view, it really is business as usual. There has been more interaction, involvement from the staff, but yeah, it sounds a bit of a cliche, really, but it really is business as usual. So I'm actually.
No, I think that's very important, Gareth. I think one of the principles that we try and establish is go slow on that change management.
Yeah, absolutely.
Yeah, we want to hear from them more, but we don't want to run the business by committee. And the worst thing you can do is make such a fanfare about it.
Absolutely.
That everyone gets distracted. So we really urge a very slow transition. So I think people get so excited and caught up with this. This is going to be an employee-driven business model, and we're going to have this committee, and all these employees are going to pick up with all these ideas and help drive the growth. And it's like, well, maybe some will, but many still want to just take their money and do the football coaching on Saturday, and that's their vision. And this won't make that much difference to them.
I think it's, and that is something which, without trying to go too hard, like we did say, look, you will in effect own this business, but the business, the shares will be held by trust. So the minute you leave the company, you're no longer part of it. So it will be business as usual, and the management team will still run this business without a shadow of a doubt. And I think that goes back to a lot of your coverage with regards to this not being commercial. Well, you've got to have the right guys below you to bring onto this scheme in terms of the management. But I mean, some of the guys we've promoted from within, by the time these loan notes are paid off, Kevin, they'll be, crikey, tripling what they would have been earning previously. So, all right, if you've got 3 Alan Sugar wannabes within your tier structure below you, they're going to bring in, again, that maybe goes back to the decision about, well, is this going to be right for us or not? Possibly not. But yeah, I mean, one individual in particular who was a vendor as well, a minority shareholder, he's bought into it. He's bought into it 100%. Took a little bit of, consideration and a few conversations with Kevin and I, but
they didn't really want to sell, which is one of the questions. They didn't want to sell. I mean, we got them on board because they actually hadn't appreciated the value of having cash at 0% in their back pocket.
Absolutely, yeah. So
and the certainty about sales, because one of the problems is if you retain a minority in a trust sale, who's going to buy it? What's the liquidity of those shares? So it is better to explain to them, get a bird in the hand, get your 0% tax, take that now, go and make your wealth by doing other things, and then let's look at your pay package.
Absolutely, yeah. And they certainly are paid in the upper quartile without doubt. Certainly, yeah.
Very positive. Yeah. But can you stay on the board, Gareth? As a manager, I'm going to check your technical awareness now, because I think I remember covering this with you, but I don't.
Yeah, you absolutely can, can't you? Because my colleague Paul was the other majority shareholder, and he has stayed on the board as well. As long as there's a clear change of overall control. So, the guy, one of the guys who was minority, he is now the managing director. One of the contracts managers is now contracts director. So there's a clear change in control, and I've now stepped back, and I'm still within the business and as the trustee seller, the trustee vendor. So yeah, absolutely.
We did one of these, I think it was 10 million, where a very successful guy, where there was only one owner manager. So clearly he's also had to wear 2 hats. He's had to sit on the trust and the management.
Wow, yeah, crikey, yeah.
So it can be done, but you do need to, again, make sure that, okay, but I can't now be sole dictator. I'm going to build my team and panel around me in terms of that board, which is where we use non-execs. We've also got one at the moment where I think this is probably a 5 million one, where we've got three key guys that want to leave, they don't really have the second tier, but because they're getting enough money out on day one, they're happy to take the risk of backfilling that management and building that team behind them. So, yeah. And it's a very, very established business. So actually, instead of recruiting people going, well, you can be, maybe you will do a management buyout, maybe it'll be a trade sale, but who knows, and just come and join us. Now we've got a real story, which is actually we should be able to persuade better talent to join us, because you're back to that pay in the upper quartile type situation. So actually it's a really good recruitment principle for senior management. So would like to put in place a similar structure, John Lewis and Partners, where all employees are partners of the business. Well, we call them co-owners, but yet John Lewis called them partners. What percentage of the dividend is distributed to partners? And also, could you pay bonuses sufficiently to partners rather than employees? Well, so we call them co-owners. With the bonus structure, Gareth, there's three rules, isn't there? Sort of hours, length of service, or pay. What did you choose in terms of the bonus?
A combination of three.
You went for a combination of three.
Yeah, combination.
I was advising only hours, wasn't I? And you guys went, no, that doesn't work. Why did you conclude that in the end?
I think we just thought with the just the general way our system works, the way our business works, that was the fairest way to go about things. Again, each business is probably going to change, you know, that perception or how they would like to structure that bonus system will probably change from business to business, but that's the way we chose. But it's flexible. But it has to be equal. So you can only do it on those three rules. Yeah. And typically, we're not looking to distribute all the profit. Initially, it's, you know, and just to use you some of the tricks we've used, but say the guide might be 1% of gross profit or something. And it's really, how do you get it to 800 or £1,000 per head to start with, and then how do we turn that up? And that's a key part of the strategy and thinking on the bonus. Okay, we had a question here. How do we value the company? Do you want a go on that, Gareth? No, I'll let you do that, Kevin. You're far more technically astute than me on that. Right. Cash flow valuation, not EBITDA comparison. We don't tell HMRC that. We justify HMRC with the EBITDA comparison. But a company buying itself for the benefit of the employees, money only comes from one place. What's the cash flow and headroom in that cash flow over the next 7 or 8 years? And also add to that, is there spare cash on day one? Add those two up. Is that reasonable on a comparative valuation basis? And then justify that to HMRC. So it is a third-party arm's length valuation. The other thing we're trying to do, we need to balance. I do kind of a superhero drawing. You imagine a triangle. You've got employees, shareholders, and then the trust. You've got to balance all three of those requirements. And then the superhero calls HMRC in the middle, the 0% tax. So we need to look at all three of those elements to create sustainability. And so, but the one thing with the EO is you can, because of the loan notes are promised to pay subject to cash flow, as Gareth has said, you could accelerate those and or extend the period out depending on the success of the business. So yeah, we want to go in with a full commercial valuation wherever possible, because frankly, we've got the opportunity to perhaps climb down from there if the business is not as successful. And you don't really have that with most management buyouts. So much more flexible than those sales. I think that was a great explanation, Kevin. Karen's made a good question here. You know, did it help your management team going forward? It's actually only one member, Karen, that had shares. Sorry, that's not correct. There's two. So one was a majority, one was a minor. Absolutely, in terms of, well, I suppose if you think about it, obviously with the vested interest in particular that the managing director has to get the full value of his minority stake over that period, I think it absolutely helps. I wouldn't say that's a hard and fast rule. I think it really depends on the individuals you've got to try and promote within to that team. I don't think it's a necessity, but I think it helps, doesn't it? Do you agree, Kevin? Or? I do agree. I mean, I think you say actually, and I'd like to chew the fat on this a bit, Gareth, if that's something. Yeah, of course. This is the central question for me with employee ownership trust. You know, can you create a business
where people don't have the same skin in the game as shareholders, but still do that sort of, hardball 24/7 that it takes to run businesses in choppy markets, right? And I think, I say 24/7 with flexible working these days. I'm aiming at the 7-day weekend, but you know what I mean. You still wake up thinking about it. You go to sleep thinking about it. Can you do that with employees? I believe you can, but what's your experience so far?
Yeah, I think so. I think it goes back again. We touched on it previously, didn't we, about where the individuals are currently in terms of ambition, pay structure, and all the rest of it. It's a massive point. And again, without homing too much on it, Kevin, the one individual in particular, perhaps has more of this Alan Sugar mindset. But I think with a careful bit of consideration and the fact that the value he was getting at 0% capital gains on his current shareholding obviously opened his eyes up. That coupled with the fact that once the loan notes are paid back, yes, there's significant advantages to investment in the business and also the employees in general, but also, most importantly as well, to increase the salary of the management board who are running the business. The employees are important and they have a voice. They have a voice within the trust. And if you go down the council route, I don't know if Kevin wants to mention that or not. We didn't go down that route, but that's another probably conversation to be had. It is the management team that are driving the business, so they need to be paid well, and they certainly are in our experience and in our circumstance.
So that's a question we've had from David, is how the remuneration board operates. But ultimately the management set that salary. So the comparison I would use is that if you've got second tier at the moment, shareholder value business, let's say they're on 60-70, we need to build a business model very quickly where they can move to 80s and 90s, and they need to get better at pension planning and so on. Once the loan notes are paid off, then they're setting the salary. So are they going to be on 130, 140? Possibly, but the trust will turn around if they say, well, hang on, we've only grown this business by half over that period, but I'm brilliant, I'm Alan Sugar, I'm worth $500,000. The trust will go around and say, I don't think so. That's not in the interest of the employee. So we're back to that balancing act. The management set the panel, the remuneration, they control that panel, but the ultimate truth sayer, as you get with investors and PLCs on the remuneration panel, is the trusts, and they will have final say on it. But we've got, think again of these almost like a family business for employees. You've almost created a family environment where all the employees are co-owners. We've got a very successful family business where the lady would have loved to have shares, but because it's very successful, she gets paid $400,000 a year. And she puts all her money into EIS and VCT qualifying shares and so on, and she's making her wealth through those tax breaks on that front. Doesn't have to be through the company. Again, that's why I use the comparison. Think almost mini PLC for employees around that. So I'm just mindful of time, Gareth. We've only got 5 minutes left. I've got a sort of another sort of key question for you. If you had any regrets on the process, not just
personally.
Sorry?
Personally.
Yeah.
No. I mean, if you from a vendor's point of view, the tax benefit is obviously huge. When you're talking about vast sums of money like we are. Okay, some of these circumstances will vary massively, Kevin, but from my personal point of view, that was it was a very huge. I'm not going to lie to you. I don't think there's anything bad by saying that as well. It was such a huge advantage tax-wise. But once you buy into the concept, and for a lot of the points Kevin's made earlier, about sustainability, and there will be an element of inclusion, obviously, from the employees moving forward. It really is a great model, and we bought into it not just because of those reasons, as I said, but it's a lot softer exit for us vendors personally. So it has a lot of benefits.
So how long are you going to stay, and what are you going to do next? Because that's actually important. Because one of my views is that especially at your age, and I know you're a young man, Gareth, or you look younger than you really are.
Yeah,
But,
appreciate that.
bottom line is some sellers sell out their business and they have what we call grief because they're used to being really busy, and then all of a sudden, overnight, they're not important anymore. The emails stop. There's nobody ringing them. They're just another rich person, right?
No, I mean, personally, I've got other plans. As we've had many conversations, Kevin, as part of the structure and the deal to comply with this change of control, I went down to 4 days, as Paul did straight away. I've actually dropped down to 3 days now moving forward this year because we wanted to give it 6 months to see how things have gone. And things have gone great, and the management board and Dominic, who's taken over as MD, the minority shareholder previously, is doing his own thing and he's doing really, really well. So I've got other plans personally, but I will stay within the business. Whether I stay beyond the loan note payment period is up for debate. But again, individuals will look at that differently, and there's no reason why you couldn't stay on past that. I think Paul certainly will stay on past the 6 years because at the moment he doesn't have any other outside interests or anything else financially going on to move on to. So he's quite happy to stay on 4 days a week for as long as they want him.
It keeps you busy. Although we might be saying to ex-sellers, look, let's reduce your pay in favour of loan note. Obviously, don't put it exactly that way, and from a tax perspective, that is an area to be thinking about on planning. I've got one final technical question here. Any stipulations around the loan note repayment period? Yes, and this is a house style from Avondale. I think once you get outside the sort of 6 to 8 year type period, what happens is there's no incentive for the management. Again, you lose alignment because it takes too long for them to go, hey, where do we get that greater input on remuneration and pay once these loan notes are paid off? So it's almost too long a cycle. In the end, these are leveraged buyouts, very tax effective leveraged buyouts. But if it takes too long for the payout to occur, that's probably not fair within the shareholders. Now, I think if the shareholders are going to carry on working flat out 24/7 for the next 6 or 7 years, you could probably push that up to 10. But if, like Gareth and Paul, we're looking to go, well, we've done our 7-day weeks. We're now, we've got the golf, we've got the cycling. I think Gareth is your one.
All sorts, yeah.
All sorts. So I think you've got to leave headroom for the next gen to go, do you know what? We can see the end of this in terms of time period. Okay.
There's one other one there, Kevin. Do the shares have to be held prior to transfer?
Yeah. Do the shares have to be held for how long do the shares have to be held for prior to transfer? You've to get, there's no capital gains tax here, so you could get involved in changing shareholders beforehand, but of course you've got to be careful about gifting and so on. So you can't transfer shares to somebody at lower than market value and then instantly go for clearance. So I think we did have a personal experience with that, Kevin, didn't we? Where we had to look at trying to change, and it was quite complicated. So it's a good idea to have that in order. You want it if you really want to have a wider shareholding before you do this, you want to be doing it a good 18 months beforehand. Otherwise, you're going for 2 clearance events, and I think that could create problems. The other thing that's really important, we are now aware that there is one resale in the marketplace of employee owned. So they can resell, but you shouldn't resell in the first year, because then it's not employee owned, and that will create a capital gains tax trigger for the sellers. Now, if the resale was advantaged enough, you could put a warranty in place to cover the sellers for their CGT. So you could do that, but ideally at least a year after. We don't think these will resell much. We think that they're more likely to be held in perpetuity, just because no one person's going to benefit from that share sale. And that's probably a better way of thinking of them. So, all right, Gav, really appreciate you turning up today. Any final word from you?
If there are vendors who are really considering, this strongly, I would jump on it before the government change their stance on the tax relief. That's my only bit of advice, because they will at some point. They will change it, Kevin, won't they?
Of course they will. Nothing stays the same forever. There's certainly death and taxes, isn't there, or something? I can't remember the phrase. Really appreciate your time.
No problem.
If anybody has any more questions for us, I'm going to be able to respond when we share the webinar, and I might be able to persuade Gareth if you've got other questions for him to contribute. We'll see how we get on. But really appreciate your time.
No problem.
This morning, Gareth. I know you've got a dash, so thank you for coming, and very appreciated. We've got some more webinars coming up. And so just to share those, if you can turn up, that would be really good. I'm just going to share those on the screen. Don't forget, we'll be sending this webinar out as a recording. So thank you all very, very much for joining today. Some really great questions. Hope we covered them all. But please, if you've got any more, email in kevin.uphill@avondale.co.uk. Thank you all for joining today. Really appreciate it, and have a great day.
Good luck, guys. Thank you.